Hello and welcome to Martin Lucas Investor. My name is Sensei, and you are here for a special broadcast of the FOMC minutes. That is going to be released in 18 minutes and 30 seconds. So let's go into our analysis. If you have just tuned in, please make sure you have hit the like button, you have subscribed. And this is going to go quick today because this is going to be a big audience, I would expect, because it's such an important event. So there's three people that in my show can get the 50% off. There was three people in Martyn's. I was not live this morning, so we had one person who signed up during Martyn's show. Therefore, there's five left. So I would expect this to go fast. Right now, there's 50% off the newsletter. This 50% off deal is not going to be happening anytime soon, if ever. It is ending on Friday. So 5 people today, 3 people tomorrow, and then essentially it's done. If you do want to get it, we have now included the chart training course in it, as well as the net worth tracker, as well as the daily newsletters, as well as the analysis, the cheat sheets. So how do you get it? It's in the live chat. It's the first link in the description, 50% off. So grab it while you can, and you'll have access to all of that. We will talk more about that later in the show, but I want to give anyone who was early the opportunity first. FOMC cheat sheet, April the 18th. The April the 8th today. Everything you need to know. The Federal Reserve releases minutes from its March the 17th to 18th meeting at 2 p.m. Eastern Time, and they arrive at a critical inflection point for markets. The Fed held rates steady at 3.5% to 3.75% for the second consecutive meeting, and the updated dot plot pointed to just one more rate cut in 2026. The Iran war was already underway when the committee met, but the full economic fallout was still unfolding and is still unfolding. Now, a ceasefire with Iran was announced this morning or last night if you're in the US. Oil has crashed towards $90 and the S&P 500 rallying over 2%. The key question, do these minutes reveal a committee that was already leaning towards keeping rates on hold all year, or one that was genuinely split and might resume easing once the geopolitical fog clears? And that's what we're going to depict. We're going to be getting the FOMC minutes in 15 minutes time, and hopefully we will get the answers to some of these questions because we get a lot of answers in these minutes. Not many people decide to cover this, but it's actually, in my opinion, more important than the FOMC itself because we get more information and a better idea of what the Fed was saying behind the scenes. If you have just tuned in, take 1 second to hit the like button. Make sure you have subscribed. And remember that 50% off link is in the live chat. It's also in the description. So, what are the FOMC minutes and why do they matter? That might be the question you're asking. Well, most investors focus on the rate decision and move on. The minutes released 3 weeks later, today, in 15 minutes, tend to fly under the radar, but they are where the real detail lives. The statement that Jerome Powell says tells you why. The statement tells you what 12 voting members decide. The minutes tell you what all 19 participants were thinking, how divided the room actually was, and what their concerns are building behind closed doors. A unanimous hold could mean the committee was firmly aligned, or it could mean several members were on the verge of voting to cut and barely held back. Now, if that happens, that will be a pump in the market, and we will be watching the markets during this event as well. So we'll look at Bitcoin and the S&P 500, of course. We will also dive into some of our other favorite assets, such as oil, XRP, and specific bonds and gold and silver. So remember, a unanimous hold, which it basically was a unanimous hold, could just mean that everyone is firmly saying, okay, no more rate cuts. Actually, we might hike rates, But it could also mean actually we're just going to hold back for this meeting. Maybe the next meeting they are very eager to cut. We don't know, but we will find out in the minutes. So what happened in that March meeting? Because remember, this is all about that March FOMC meeting. The minutes are being released in 30 minutes. It's going to move the market. So the committee voted 11 to 1. So 11 people voted in favor of holding rates steady. The second consecutive pause after the 325 basis point cuts in late 2025. Now we've basically got 2 rate pauses over the last 2 meetings. There was a single dissenter, and that was Governor Stephen Miran. He preferred a 25 basis point cut. Remember Christopher Waller, the pro-crypto, pretty much a big dove as well. He had descended for a cut in January. Now flipped to voting with the majority. A hawkish shift worth watching in the minutes. Let's see if we get a statement from him or the reasoning behind that. The statement added new language on the Iran war. The implications of developments in the Middle East for the US economy are uncertain. That's what Jerome Powell said in a statement. Powell said that hikes are not off the table. He also said that, making this the first cycle where both cuts and hikes are actively being discussed. He described the current rate as within a range of neutral. So either way, we're not looking to move too much from the levels we're at now. So if you're expecting 5 rate cuts, you're wrong. If you're expecting 5 hikes, you're also most likely wrong on both sides of this. We are around that neutral range, which keeps the economy, the jobs market under control, and inflation under control. Remember, that's that sweet spot we're looking for, and Jerome Powell is saying we are within the range of neutral. We also got the dot plot. Remember that. The updated dot plot kept the median at 125 basis point cut in 2026. So this is all the Fed participants coming out and saying how many rate cuts they assume, and the median, which is a type of average where you get rid of all you sort of move in, so you get rid of the high ones, get rid of the low ones, move in. That is looking at 1 rate cut in 2026. But when you look at the distribution of that, it actually shifted hawkish. 7 of the 19 participants now see no rate cuts at all. That was up from 6 in December. And a 14 cluster around 1 or 0. So we're starting to see that cluster, that move in people's decisions going closer to no rate cuts, but still slightly in favor of 1 rate cut. Inflation predictions rose sharply as well, with headline and core PCE both revised up to 2.7% from 2.5%. GDP marked up to 2.4%. Unemployment was held at 4.4%. We've got a special guest on the show.
At Diesel_Ada tipped $1.99 through Super Chat. Sensei THX for all you do. Are we okay with nappies? Fafo.
Thank you very much, Diesel Raider. We're all good with nappies. I appreciate it. Thank you very much, Diesel Raider. My question is, what would Trump want? Hike, cut, or hold, says RoPro. I think we all know the answer to what Trump would want. The key numbers heading into today's release. So now, if you have just tuned in, can I ask everyone to hit that like button? Make sure you have subscribed. If you want the cheat sheets like this, if you want the daily newsletter to keep you up to date with the news, if you want the best chart training course, which is based on academic research. It's not promising you get rich overnight, but it's giving you all the skills you need and how to actually make money. If you want the net worth tracker, which is such an essential tool to see where you're at, budget planner, debt planner. If you want access to the private Discord where I will share all my trades, my thoughts, and we have a discussion. Also the integration with Martyn's Discord where you can chat to the members there as well. Plus the £5,000 portfolio challenge where I will be doing 24 hours worth of research to execute some money and see if we can execute some trades to see if we can get to 100,000 and then 1 million. If you want all of that right now, 3 people, actually it's 5 people because we're combining Martyn's and mine for this event, and Martyn sold that 1 person signed up on Martyn's event, so there's only 5 left for today. And remember, the 50% deal is going away by Friday. So last chance. If you want it, you can get 50% off. The link is in the live chat. It's also the first link in the description. So some of the numbers heading into today's release, you can see where the rates are at, the March vote, the CPI, all of these numbers are available on that newsletter if you want to go check it out. And then what do we want to see? Some of the wording we want to see on the dovish side, on the bearish side. Again, I don't want to share too much because we do want to reserve most of this for our premium members. But we've got essentially depending on what they say in this report, um, we've got written down what is the most important things, whether it's hawkish or what statements will be hawkish, what statements will be dovish, and what will be neutral. That is in today's newsletter, but I'll skip over that because I don't want to give away too much. We will be covering the event, so we will be able to see how the market reacts. Let's go on to our next bit of information, which is the economic picture. And of course, we can't ignore the Iran war and the oil shock. So, Operation Epic Fury was launched on February the 28th. It triggered the largest oil supply disruption in history. Brent crude hit $120 a barrel in mid March before this morning's ceasefire that crashed it towards $90. So we are still fairly elevated, but we're below that key $100 mark. The longer we stayed above $100, the more likely a recession was going to occur. Now we're around $90. Let's see. I mean, if it holds at $90 and starts continuing to trend to $100, then we're concerning. But if we're at $90 and we continue to trend down to maybe $80, $70, $60, then we're sort of in the clear. Remember, the Strait of Hormuz was essentially closed for weeks, and that was the choke point of 20% of the global oil supply. We're looking to see now if today the ships are going through, and the market's expecting that they are. The war was already 17 days old when the FOMC decision came out. They acknowledged it directly in the statement, but the conflict was still fairly raw. Oil was moving all over the place, it was moving fast, and the hard inflation data hasn't caught up yet. The February CPI 2.4 year over year, core 2.5%, was collected even before the war began. The March CPI, the first inflation report we're going to get that's going to take into account the war, the oil shock, the fertilizer shock, the diesel shock, all of that shock, is going to actually be tomorrow with PCE, and then Friday with CPI. So over the next 2 days, we're going to get really, really important inflation data, and we'll be covering it live on the show. That's going to be about 2 hours before the opening bell, is when we're going to start getting that data over tomorrow and Friday. And yes, I will be live covering those events. And that's all about inflation, which was trending down, but not fast enough. So February's CPI came in at 2.4% year over year, with core at 2.5%, the lowest since April 2021. Shelter eased to 3% year over year, and rent posted its smallest monthly gain since January 2021. But tariff-sensitive goods told a different story. Apparel was up, household furnishing was up, tools and hardware was surging 6.4%. Core PCE, the Fed's preferred gauge of inflation. Remember, the Fed likes to look at PCE, the market likes to look at CPI, and I like to look at PPI. That actually jumped to 3.1%. PCE is the one that the Fed wants to see go to 2%. So if you've ever heard about the 2% target, that's in regards to PCE inflation. And that actually jumped to 3.1%. So over 1% away from the Fed's target. That's going to be released tomorrow, and it's still expected to stay around 3%. Because remember, the effective US tariff rate sits currently about 10%, and that's the highest since 1943. So tariffs is playing its role in this. Oil is now going to play its role in inflation data as well, meaning that's why the Fed aren't looking to cut rates. We're now 5 minutes away from this important FOMC minutes release. Let's give you some more information before we do cover that. We will be going over to Bloomberg as well, which will be here to give us some more information. I'll be running my analysis behind the scenes as well, and then we'll analyze this together, talk about the war, and see if there's any opportunities in the chart. So do stay with us for the next half an hour, and then we can go through all of that. The labor market. Remember, the Fed has two sides. Keep inflation under control, make sure the labor market doesn't crash. March payrolls rose to 178,000, smashing the 59,000 consensus, but healthcare actually accounted for 76,000 of the gain. The federal government shed another 18,000 jobs. Unemployment edged down, which is good to see, shows strength in the market, but also does reduce the chance of rate cuts. That edged down to 4.3%, and average hourly earnings growth slowed to 3.5% year over year. Q1 average monthly job creation was roughly 60,000. The Dallas Fed estimates the payroll break even rate has fallen to near zero, given declining immigration and labor force participation. GDP, the collapse no one expected. Q4 2025 2025 GDP was initially reported at about 3%. Then it was revised to 1.4%, then revised to just 0.7%. That was a dramatic drop from Q3's 4.4%. The government shutdown alone shaved roughly 1 percentage point off the growth. Private domestic demand was revised down to just 1.9%. The third and final Q4 estimate drops tomorrow alongside February PCE data. Despite this, the March dot plot revised 2026 GDP up to 2.4%. So essentially, the revisions we got and the data we got for the estimates of GDP, how much money the US is generating, we want to see GDP up. That means the US is strong and no chance of a recession. We want to see that number up. That came in half the estimate at 1.4. Then we got a new estimate that brought it down to 0.7%. So that's very concerning. Obviously, if we go below 0 for 2 quarters, that's a recession. So we don't want to see that happening. But the Fed doesn't see that happening because they gave us their dot plot. They gave us the summary of economic projections, and they projected that that GDP is actually going to be at 2.4%. So there's a bit of a mismatch between what's actually happening, which is quite bearish, and what the Fed is projecting GDP is going to happen, which is actually fairly okay. So let's see why they're projecting that. We'll see that in the minutes, in about 2 minutes. In the 2 minutes. Where rates, bonds, and market expectations stand right now, markets have dramatically repriced the rate outlook since the March meeting. CME Fed Watch shows a 51% probability that the Fed holds rates at 3.5% to 3.75% through the end of 2026, with just a 35% chance of 1 rate cut and only 9.5% odds of 2 rate cuts. So we're actually looking at not a very high chance of a cut. Since the war ended and the ceasefire came through, those jumped. So now we're looking at potentially a 10% chance of either 1 rate cut or 2 rate cuts. A 40% chance of about 35% chance of 1 rate cut, 10% chance of 2 rate cuts, and about a 50% chance of no rate cuts, and about a 10% chance of rate hikes. That's what we're dealing with right now. That's what the market is pricing in. Goldman Sachs says 2 cuts. The Fed Watch tool says no cut. JP Morgan says rate hike next year, and Barclays is saying cuts will be at the very end of 2026. Again, the minutes are releasing in 1 minute. That's when we're going to get the most up-to-date information, and all of these odds and all of these projections are going to change based on what the minutes say. The next meeting is almost certainly going to be a hold. That's going to be at the end of this month. That's 99% chance of a hold. And what we're looking at is further meetings down the line. So 44 seconds to go. If you want all of this information ahead of the FOMC report, if you want the cheat sheets, what to look out for, if you want the daily news that we send out, remember there's no advertisement, there's nobody paying me to write in it a certain way. There's no bias. We send out all you need to know every single morning alongside the chart of the day. We've also released our chart training course based on pure academic research, what actually works, what actual chart patterns work. The £5,000 portfolio challenge, where we're trying to turn 5,000 to 100,000. The portfolio tracker, the priority DMs, the private Discord, all 50% off right now. And I'll give you the link in the description. Let's go over to the report. Here we go. Let's go.
It's from the second Fed decision of 2026, Tim. That was back on
Let's
March
go over
18th.
to Bloomberg.
You got a rally
I'll do my
underway, though,
analysis
and
behind
yields
the
have pulled
scenes.
back.
We're waiting
this.
for
that's
Bloomberg
ahead of this.
to cover
Think
this.
back to-
I will also be giving you my analysis behind the scenes while I look at the numbers in the PDF. So stay with me, give me 10 minutes, and we'll analyze it. We'll go to Bloomberg now. The link for the 50% off is first link in the description. It's also in the live chat.
Surprise, the Iran war and tariffs were central to the discussion among Fed officials at their March meeting. The full effect of tariffs had not yet moved through the economy, officials said. A resilient economy, they called it. And the war, then only a few weeks old, raised the threat of inflation increasing and hiring slowing. Some participants judged there was a strong case for a two-sided description of the committee's future interest rate decisions in their post-meeting statement, reflecting the possibility that higher inflation might call for rates to be increased. although no member called for a rate move at that meeting. Most participants raised the concern that a protracted war could lead to further softening of labor markets, which would warrant additional rate cuts. But many participants pointed to the risk of inflation remaining elevated for longer than expected, which, quote, could call for rate increases. The vast majority of participants noted that progress toward the committee's 2% objective could be slower than previously expected, the minutes say. Labor market conditions appeared vulnerable to adverse shock, they say. Most participants highlighting the risk that a protracted conflict in the Middle East could weigh on business sentiment and further reduce hiring. As for policy, most participants felt it was too early to judge how the war would affect the economy. Many participants judging that in time it would be likely become appropriate to lower the target range for the federal funds rate if inflation were to decline in line with their expectations. A couple highlighted, though, that they had pushed their assessment of the most likely timing of rate cuts further into the future. Stephen Martyn, though not named, was the only dissenter. The minutes do note that one participant argued rates were still restrictive, and that was increasing risks to the labor market. Guys?
Mike, this is the moment where we sort of parse language here, and we ask you to translate what different words means when it comes to these minutes. The word protracted, that has to do with a period of time, a longer period of time. I go to that word because the Fed said that protracted war could hit jobs, warrant cuts. How long is protracted?
They do have a guide to Federal Reserve terminology in terms of some, many, few, etc., but they don't have a definition of what protracted means. Obviously, it would have suggested that the war could last for several months or longer. We're kind of in a middle period now. Hard to know whether this fits that model or not.
All right, Mike, we're going to come back to you in just a moment. Our Mike McKee there at the Federal Reserve. We're going to continue with Mike in just a moment. Do want to check on the markets in terms of what we've seen in terms of reaction, because
Give me 1 minute. I'm going to break down the whole FOMC, tell you what has just been said, and then we're going to look at some charts and look for opportunities.
Themes when it comes to the U.S. war in Iran. Having said that, as for the S&P 500, pretty much where we were prior to the release of these Fed minutes. Same story for the Nasdaq 100, just a little bit of a move to the upside. Probably more importantly is what's going on in the Treasury market. And I'm just taking a look all along the curve in terms of what we're seeing, and we're pretty much where we were prior to the release of those Fed minutes. So, maybe investors, of course, a little bit of, I don't know. I think they're just focused.
Let's get rid of Bloomberg for a second, because we've got a lot more analysis we need to do on these FOMC minutes. Remember, if you have just tuned in, please smash the like button. Hit the like button. Do subscribe. Not many people are covering this. Wait, we've got Mike McKee again. Let's see what Mike McKee says. I've got the full analysis for you. I've got the charts for you. Smash the like button, and let's listen to Mike McKee for just one more second.
Because the war has maybe not ended. We don't know for sure. We've had conflicting headlines all day. Most Fed officials who've spoken in the run-up to their next meetings, since the last meeting so far, have basically said the same thing that the minutes suggest, that there are increased risks to inflation that could come starting with oil prices and then working their way through the economy. They also note that tariffs had still yet to work their way through the economy, and we might get more. So there's a lot they don't know at this point, and I think the minutes really don't give us any more clarity since they were 3 weeks ago, and nothing has happened that gives us more clarity into the future direction of interest rates and oil prices and everything else at the moment.
The next move from the Fed, Mike, not whether it's going to, the Fed's going to just not change rates, but are people still thinking the next move could actually be higher rather than lower?
No, it doesn't appear that way. Right now, we don't have a good measure of inflation since the war started. Friday, we get CPI. That'll be our first real clue. And then we'll watch PPI the following week. We do get PCE inflation tomorrow, but that's for February, so it's not going to tell us anything. But the other two inflation measures will give us an idea of what the initial shock is. Now, we're already into April at the highs of gasoline prices, so we'll have to see obviously, if they stay elevated throughout the month, what that's going to mean for inflation. The word we get from oil companies and shipping companies is that this is going to take a while to work its way out of the economy, even if the war ended today. So they're likely going to be faced with uncertainty for quite some time, and I would imagine that we'll get a very similar meeting.
Okay, what we're going to do is just quickly analyze what's just come out. We'll keep Mike McKee on the screen for any breaking news, but let's go over to our analysis very quickly. So what has just happened is the Fed, let me go actually to this screen for just a second so I can read these headlines. The Fed is now actively discussing the Fed is now actively discussing rate hikes for the first time this cycle. And the language escalated from several to many participants in just one meeting. So I'm going to take Mike McKee off the screen and let's show you the text so you can see exactly what's going on. We'll also bring the charts back on the screen because Mike McKee is off the screen now and the markets are reacting a little bit positively to this. That's the S&P 500 going up. So let's take it one step back. What you've just tuned into is the FOMC minutes. The FOMC minutes, as we just explained to you on our cheat sheet, is one of the most important events we get a few times a year. And it matters a lot. Most investors will ignore the minutes. They're focused on the rate decision and move on. The minutes released 3 weeks later tend to fly under the radar. That's what you're watching right now. But that's where the real details live. The statement tells you what the 12 voting members decided. The minutes tell you what all 90 participants were thinking, how divided the room actually was, and what their concerns are building behind closed doors. So I look at this event as sort of a as if we're sitting at that meeting with the 12 participants, the 12 voting members, and seeing what they're actually saying. When we look at the FOMC event with Jerome Powell, he reads from a statement and then he answers some questions. But these minutes are what was happening in those hour-long discussions between all the members, which gives us a great indication of where we're going in the future. So some of those headlines that have just come out is the Fed is actively discussing rate hikes. So now we know this is official, this is from the Fed. They are discussing rate hikes for the first time this cycle. And the language escalated from several to many participants in just one meeting. So they're actively talking about raising rates. And it's not just a few people that want to raise rates. It's not just several, it's many participants. And if you look at our cheat sheet we released today, we described what it means to be many, because you have to understand the Fed's language. Let me remove the chart off the screen. We said the most important words are the quantifiers. A few would be 2 to 3. Several is growing momentum, 4 to 5. Many is 6 to 8. So we're talking about more than half of the committee is very much looking at raising rates now. And remember, it is a majority decision. It's not just one person. It's not just Jerome Powell that makes a decision. Everyone makes a decision. So Waller flipped. This is the next point. Fed Waller. Remember Fed Waller? He is the pro-crypto. He is the guy who wants rate cuts. We all expected him to always be in favor of rate cuts. Well, you were wrong. Fed Waller flipped. The man who voted to cut in January switched to holding in March, leaving Martyn as the only vote for a cut in the entire committee. So only one member of the Fed, Governor Martyn, is voting for cuts. That is not a very. That doesn't mean that doesn't really show we're going to get cuts anytime soon. If only one member wants cuts, and the other dove, who was Fed Waller, is flipped to being no cuts. The next major point from these minutes, if you have just tuned in, please do hit the like button. Please do make sure you have subscribed. We're covering one of the most important events of the year so far. So please do smash the like button, subscribe. Let me just show you this as well, and then we'll come back to our full analysis and then the charts. We created our very own newsletter. I set out on a mission about a year ago, actually, to go against all these major news organizations that were full of advertisements, full of bias reporting, and they weren't there for the retail investor. We brought out Sensei.news. And we've got a free plan for most people. Love it. Every single day you get the top stories, the main stories you need to know. And the reason I set out to do this is because once I learned the charts, and once I understood that you need to have the news alongside it, I started making a lot more money. Not when I was subscribed to 50 different news sources. I'm talking Financial Times, Bloomberg, Reuters, Barron's, the New York Times, and spending £500. I was spending about 500, 400, 300, £400 a month on news sources. And I was reading every news source, but there was major issues. It was expensive. There was a lot of advertisement. There was a lot of bias. When you start understanding who's writing these articles and why they're writing the articles, you will see the bias. Anyway, it was great because I started making more money, but it was annoying because I was spending a lot of money on the news, and also it wasn't the best. So what we've done is we brought out the news, our new newsletter, which will essentially give you the 5 most important things happening every day. So every morning you'll get the 5 things you need to know, the money move of the day, my chart of the day, the deep dive, and that's all you need on the news side. But you also need to understand charts. So this week we just released our very own chart course. That will give you academic researched ways that charts actually work. Not just people online telling you you're going to get rich quick, not just people telling you online in their rented Lamborghinis how to make money and giving you alerts. That's not what this is. I am teaching you everything I learned in the last 8 years about charts, all the money I spent on courses. You're going to get plus 3 private indicators for members only. So my own trading view indicators that again are not signals, although there is a signal element to it, but very much to do with moving averages, keeping things very simple. You get macro event cheat sheets. So if you enjoy trading, if you like the FOMCs, if you like data events, and you want to make sure you're on the right side of the trade and understand those events, what we actually do is we put together cheat sheets for those major events. We've just released the chart course, and that's part of the subscription. I've also trying to turn 5,000 to 100,000. That's the portfolio challenge. 24 hours of research goes out on that. The portfolio tracker app, again, no ads, no data tracking. I have access to none of your data. You can track your net worth, type in your debts, your budget, your expenses, your income. You can model retirement. You can model income changes. You can model your kids going to university or whatever you want to do, and you get your net worth because it's so important to understand where your finances are. You also get priority DMs, so you can message me one-on-one, and you get access to the private Discord channels as well. Right now, and it's going to end, and there's only 5 people that can get it in this show. Some people might have already got it, so there might not be any left. I will check in a minute. I assume there is still a few spots left right now. This is ending shortly, 50% off. We probably won't do it again. And if we do, it'll be a few months down the line, maybe Black Friday. But 50% off, 5 people only. The link is in the live chat. You get it for 50% off. That works out to under $10 a month for all of that. I'm not just talking about just the chart course. I'm not talking about just the app. I'm not talking about just the daily newsletter. I'm not talking about just the cheat sheets. It's all of that bundled together with the Discord access for 50% off. That is in the live chat. It's the first link in the description. Obviously, you have to be fast because this is a large event, and I assume that will sell out very quickly. Let's go back to our analysis of the FOMC minutes. So the 2 big things we just discussed, the 2 major points was many participants are talking about hikes now. That's gone up to the majority, essentially. Fed Waller flipped from being dovish to hawkish. And then, here we go, the staff downgraded growth and upgraded inflation at the same time. That is the textbook definition of stagflation risk. And now it's on the Fed's own projections. We got that as well. The Iran war made it into the official FOMC statement for the first time, with the committee calling it too early to know. Let's bring the charts back on the screen because Bitcoin's going down and the S&P 500 is going up. A very strange thing we're seeing right now. Money is flowing, I would assume, from the crypto market to the stock market as we speak. We will look at the charts in a second as well. The labour market fears came roaring back in January. The vast majority said employment risks have diminished. 6 weeks later, vast majority now says those risks are elevated again. Okay, people are now, the Fed participants are now worried about the labour market, which obviously will help rate cuts, but it's actually in the cycle we're in now, we don't want the labour market to go down because inflation is going to be very high due to the Iran war. Let's go through a few more of our top points after the FOMC release, and then we'll come on to the charts, your questions as well. Let me remove the charts for just 1 second. We are looking at Bitcoin, the S&P 500, gold, silver. We'll come back to that. So Fed Waller flipped back to holding. The vote narrowed to 11-1. Miran was the sole dissenter, still pushing for a 25 basis point cut. This is the administration's appointee, whose term technically expired on January the 31st, and who is only still voting because its successor has not been confirmed. So essentially, the one person who's voting for rate cuts, he's going to be leaving soon. He should have left last month, but he's still here because there's not the next successor, and it looks like he will be the only person who'll be voting for cuts this month as well. Here is another behind the scenes look at what the Fed were discussing on the FOMC, and this is why we love this event, because we get to see what they were really talking about. And this is what they were talking about. The Iran war dominated the discussion. Remember, the war had been going on for 2 weeks at the last event, so they had a little bit of time to process it. And it seemed to really dominate the discussion. And if it was dominating their discussion, that means that is the biggest risk to what the Fed's decisions will be, was the Iran war. But the committee did explicitly say it's too early to know. So they need more time. And it was only 2 weeks, 3 weeks maximum that the war was going on when the Fed met. So they wanted more time, but it was certainly their biggest point of discussion. Most participants used exactly that language. The committee is treating the conflict as a source of uncertainty, not a reason to act in either direction. This is the wait and see outcome that we discussed in the cheat sheet just a few moments ago. Downside risk to employment came back, and this is quite a concerning point. So we've just heard that they started talking about employment again, and they started being worried about the employment market. In January, the vast majority said employment risks had diminished. So this is the meeting before. In March, which is what we're talking about right now. Oh, look at this. We've got a super chat. This is amazing. Look at this. Poor man to rich man. Oh, it's not playing. Why is it not playing? Oh, I've muted it.
Couple XRP on me, smiley face emoji, red heart emoji. Sorry for interrupting the news.
No
Smiley
worries.
face
You're not
emoji.
Thank you so much, Poor man to rich man. Let me read the beginning of your super chat again. I apologize. I muted it. Thank you, Sense and the team. Love you, love to you, family. Stay safe. Thank you so much, Poor man to rich man. Really appreciate it. A couple XRP on me. I love it. I can always do with a couple more XRP. Thank you, Poor man to rich man. I will come onto all your comments and questions. We do have a poll running right now. Will the Fed cut rates in 2026? Please do vote, and that poll will come to it. Oh, look at this! I'm telling you, these minutes are not bullish at all. And here comes the crash. Here comes the crash. Look, it could be a crash to buy back, but so far what we're reading is really not that great. So the downside risk to employment came back, which is not brilliant because essentially they just said recently that employment is no longer an issue. It's behind them. In January, the vast majority said the employment risk had diminished. But in this meeting, the vast majority now says both upside risk to inflation and downside risk to employment are elevated. The dual mandate tension is back, and it's more acute than any meeting since October 2025. So we've got that real stagflation risk, and I know Jerome Powell doesn't like to use the word stagflation, and he says we reserve it for the worst moments. But what we've got going on is inflation up because of tariffs, and inflation up even more because of the oil shock, even though the war's ended, which is great. It's still up, and there is still a shock there. So there's double shock on tariffs and oil, and then the Fed participants are now actually saying unemployment is a concern as well. And if unemployment goes up, both mandates of the Fed, which is their job, is essentially to bring inflation down to 2% and keep the jobs market in check. Both of them are going the opposite direction. So inflation's going up, and unemployment's also going up, which doesn't allow them to cut rates. And then, of course, we got more talks of rate hikes. So in January, several participants raised the probability of hikes. In March, some participants judged there was a strong case for including rate hikes as a possibility in the official statement. Many participants explicitly said rate increases could be warranted if inflation stays elevated. The hike discussion is no longer a fringe view. Okay, so previously, most people said, okay, now we might start talking about hikes with inflation. This was before the war. And now most people are saying we really need to start thinking about rate hikes. Not that that's their next decision. They have made it clear that they're expecting one rate cut this year. But there are many participants, which is essentially 8 or more, around 8 people in the out of the 12, 7 to 8 people out of the 12 are saying explicitly said that rate increases could be warranted if inflation stays elevated. So it's all about inflation. And tomorrow we're going to get PCE, and on Friday we're going to get CPI, and they are going to include the oil shock. So tune in 2 hours before the opening bell. I'll be live tomorrow and the day after to cover PCE and CPI. If they are going to stay elevated, or depending on how much they go up, because we know they're going to go up, that will determine whether rate hikes are the next move from the Fed. Now let's go into a quick fire round where we look at the dovish things said in this FOMC versus the bearish things. So I'm going to remove, we're looking at the market coming down as we speak. We'll have a better look at the market once we're done with our report. I want to remind everyone we are currently running a 50% off deal on the newsletter. Remember, it's not just the 5 things, it's not just the daily newsletter, it's not just the cheat sheet. What's now included is the chart training course. It's a private course just for the members. It is about 3 hours long, but it's everything you need to know. 8 hours of knowledge in 3 hours, all the mistakes, what actually works, academically researched, not just based on random things, which is 99% of all the courses out there. You get 3 private indicators. You get access to the private Discord, the specific channels for the newsletter, and it gets integrated with Martyn's Discord, so you can have a couple channels where you can speak to the Discordians as well. You also get access to the net worth tracker, the cheat sheets, and much more one-on-one DMs with me. It's 50% off right now. I will have a look at how many is left in just a second. But there it is. The link is in the live chat. First link in the description. Once you click that, you can go over. If you choose the annual plan, you get the 50% as well. There is also a free plan. So if you just want the free plan, there is also a free plan. But right now, the best deal is for the premium plan. So quick fire round, the dovish things that were said. Most participants, and I want to see if I can make this smaller so we can see this. Yeah. Most participants raised the concern that a prolonged Middle East conflict could weaken the labor market and warrant additional rate cuts, though reduced purchasing power, tightening financial conditions, and slower global growth. So very, very interesting. Remember, rate cuts will support the labor market, and rate hikes will control inflation. And again, this is the stagflation risk. A lot of people said, and it makes sense, but we need to look at the reverse. A lot of people said this Middle East conflict could weaken the labor market. And how do you support the labor market? Well, you cut rates. So what they're saying is this Middle East conflict could certainly weaken the labor market, which could warrant additional cuts. But that's just looking at one side of the problem. What's the bigger story right now? Is it unemployment going up or inflation? Right now it's inflation, but unemployment can catch up quickly, and that's when you have stagflation. Next, which is another bullish statement, is many participants still judged that in time it would likely become appropriate to lower the target range if inflation declines as expected. The easing bias is not dead, just frozen. So the view is still from the Federal Reserve, and we've confirmed it in these minutes, the view is essentially still hold, then cut. The view is still we're going to hold rates for the next few meetings, and then maybe by the end of 2026, they're expecting 1 rate cut. That is still the base case. That is still what is most likely to happen. But remember, what's most likely to happen is actually not always what's going to happen. We looked at the odds on the Fed Watch tool, and it looks like about a 50% chance. The market's pricing in a hold for the whole year. The Fed is saying 1 rate cut. So take that how you will. The Fed is saying 1 rate cut. The market's saying no rate cuts as the base case. I would probably agree with no rate cuts, maybe one. So everyone's expecting no rate cuts, maybe one rate cut. But what is now starting to also make its way into the odds market and starting to become a bit more clear is rate hikes are on the table. Rate hikes are certainly on the table now. Another dovish statement in these minutes was several participants said housing services deflation will continue to push overall inflation lower. Same language as January. So there is a part of inflation, the housing services, which is expected to continue to come down, which will give us some relief on inflation. The staff still projects inflation returning close to 2% by the end of next year once oil and tariff effects fade. So this is a bullish statement. Remember, the Fed just doesn't look at the war in Iran and go, oh my God, we need to raise rates right now. Or they don't look at tariffs and go, we need to raise rates right now. Because they are forward looking. They understand that they believe tariffs are transitory, meaning it's a one-time hit to inflation. By the time we circle back next year, that inflation's gone. And they expect the same with the Iran war. They're saying a year from now, oil is going to be much more steady. It's going to be lower. And this is just a small shock, and we shouldn't make decisions based on small shocks. The interesting thing Jerome Powell said in his last FOMC was we can't ignore it because we've already basically ignored tariffs. And if we're going to put oil on top, we can't just keep adding inflation to inflation and just saying we're going to ignore it. So that is something to really take into account is, yes, the inflation is, they're still expecting to come down to 2% by the end of next year, but that's once oil and tariffs effects fade, and the Fed can't just keep stacking, looking at inflation going higher and higher and not acting as well. Longer date, but that is slightly bullish because they are still expecting once this all clears, oil and tariffs clear, that should be by the end of next year, as long as there's nothing else to add to inflationary pressures, no more bills that will just make the government print money and wages to go up a lot more. If none of that keeps happening, then and there's no risk of that happening, and the war's ended, then actually, if they are still on their target to 2%, end of next year they're going to go to 2%. Well, they don't really need to raise rates. Why would they raise rates? Longer dated oil futures rose far less than the front month, 50% front month versus very little change further out. And forward inflation compression beyond 1 year was little change. The market is treating energy shock as temporary for now. So they also discussed behind the closed doors, because remember, the report we're just seeing right now is based on the behind closed door meeting. And it's being said essentially that this is the longer dated, or this is a shorter term shock, and the market's pricing this as a shorter term shock, which is obviously a dovish reading. So the main dovish statements are the war is going to cause the labor market to weaken, which is going to mean that they're going to have to cut rates, which is not really that bullish. It is dovish, but it's not bullish. Market participants said that we are still expecting cuts this year, which the Fed participants are expecting still rate cuts this year, but the market doesn't believe them. Several participants said a part of inflation is coming down. That is actually dovish, because if the housing services inflation comes down, then that's going to be great, because we've got a lot of things going up in the inflation reports. Remember, tomorrow PCE, Friday CPI. It's all about inflation now. Several participants expected higher productivity growth from AI, deregulation that could put a downwards pressure on inflation. That's also what the Fed is expecting, which is also going to bring inflation down. But is it going to bring it down enough? We'll have to find out. So a few dovish points, but let's look at the other side of the stick, which is the hawkish quotes from this meeting. Argusman, I'm just looking at the chat very quickly. Sell the S&P 500. Is FOMC good? I'll give you my final reaction in a second. Argusman says, just follow the trend. Well, if you want to understand the chart training course, we talk about the trend as the biggest, most important thing. And we give you the indicators, actually tools to allow you to follow the trend. And a lot of what we look at is trend following. So you are correct. But if you want more information, go to the chart training course. Right now it's 50% off. The link is in the live chat. It's pinned. It's also the first link in the description. This will be ending soon. I wonder if I can give you the data on how many is left. If you bear with me 1 second, let's have a quick look. I just want to see if it's sold out or not, if I need to mention it, or there's none left and everyone's going to a page and there's none left. Let me have a quick look. Here we go. Okay, so Am I giving you guys? Let me just check the link. Yeah. Yeah, there's still 3 spots left. So if you do want if you still want the whole, the best offer we're running is the 50% off. It's working out to about, it's under $10 a month. That's less than 30 cents a day for all the news, the chart training course, the Discord access, the one-on-one access, the indicators, the private indicators that I'll give you access to. You can get 50% off, and there is still spots available right now. Yes, there is. Okay. Now let's move on to the hawkish statements. Then we'll wrap it all together in just a second. So hawkish, the vast majority of participants said progress towards 2% could be slower than previously expected, and that the risk of persistent above inflation had increased. This is an upgrade from January's most participants. So the vast majority of participants said progress towards 2% could be slower than previous. Yeah. So essentially they're saying inflation is not going to come down as fast as we might have expected, and that the risk of above target inflation staying there is quite high. So that's definitely a hawkish statement. Many participants pointed to the risk that inflation staying elevated could call for rate increases to help bring inflation down. Of course, that's the big news today, which is many participants, and again, we're talking 7, 8 out of 12 people are saying we're looking at rate increases to help bring inflation down. That is a stronger revision to what they said in January, where they said several raised hikes as a possibility. Now we've gone from several to many, and remember, many, if we go back to our cheat sheet, is between 6 to 8 people, 6 to 8 participants out of 12. Some participants judged there is a strong case for describing future rate decisions as a two-sided in the official statement, meaning hikes could be explicitly on the table. Yeah, you might start hearing about hikes a lot more in these statements from Jerome Powell. We're getting another FOMC later this month. This went further than January. Several participants indicated they would have supported two-sided language. So what they're saying essentially is we need to start talking, and this is the Fed. They need to start talking. What they're discussing is they're saying that they need to talk about both sides. When they start talking about the decisions, we're not just talking about rate cuts and holding. They need to. Some participants are saying there is a strong case for describing future rate decisions as two-sided, as saying either we're going to cut or hike, and bringing the language back in that hikes could be the very next probable decision. They also discussed core PCE hitting 3.1% in January, up from 2.8% in the prior reading. The staff estimated February at 3%. The trend is flat at best, moving the wrong direction at worst, is what they spoke about. In 5 minutes' time, we're actually going to be going over. In about 5 minutes' time, we're going to be going over to Vaz. He is our EVTOL expert. It is the most exciting, and I'm not just saying this. It could actually be more exciting than crypto, in all honesty. But I won't go that far yet. But genuinely, I would say I am more interested in the sector right now than crypto, especially with the bear market we're in crypto and the opportunities we see in this sector, which is the EVTOL sector. These are essentially flying taxis. We've got an expert, the biggest expert in this sector, who broadcasts to social media, to YouTube, to TV. We're looking at Vaz. He is from EVTOL Hub. He talks all about FTOLs, flying taxis. There is no bigger person with a presence on social media that talks about EVTOLs as much as Vaz does. He does daily briefings. He tells you all about the market. He looks at the companies behind these vehicles, and it's a very interesting area. Yes, it's high risk, but I do like high risk sectors because they've got high rewards as well. So be careful, but Vaz will give you all the information. He goes live in about 10 minutes time, 5 to 10 minutes time. Vaz will be live. He's on this channel. We're going to go straight to that event because that has been scheduled. And it is an event that nobody that's watching now would want to miss. At least go in there for the first 10 minutes. Just understand what the EV... I'm sure Vaz will give a quick introduction about the EVTOL space and some of the major companies within it. Because some of these we're actually working on behind the scenes. We're looking to buy some of these companies as well as part of the challenge. So I'm working with Vaz behind the scenes. So if you want to get a little sneak peek of that, stay where you are. In 5 to 10 minutes, we're going to be going over to Vaz directly on this channel. He's going to talk to you about flying taxis. Back to the report, the FOMC report. Some participants judged there was a strong case for describing future rate decisions as two-sided. We've covered that. PCE, inflation going up. And they're saying the trend is flat at best, so 3% at best, and moving the wrong direction at worst. What's actually going to the straw that's going to break the camel's back, or the final piece of the puzzle, is tomorrow and Friday with inflation, because we're going to get PCE tomorrow, the Fed's preferred metric, and we're going to have to see how bad the shock is to inflation. If it goes to 4% or 5%, then yeah, rate hikes are definitely coming. If it's a bit less, then we can start looking at a one-time shock. And it looks like it's all to do with inflation now, and potentially not just inflation though anymore. It's not just about inflation, it's also about the labor market. Let's just continue with some more of these hawkish statements from today. The staff revised the inflation forecast higher, reflecting tighter resource utilization and higher core import prices, same direction as the January revision, meaning back to back upwards revision. So they are looking to increase, they have increased their inflation thoughts. They think it's going to go higher. The staff downgraded, and this is the Federal Reserve staff we're talking about. The staff downgraded the economic activity outlook, projecting growth about in line with potential rather than above potential that was said in the January meeting. So that's changed. The GDP picture got weaker while inflation got worse. That combination is the definition of stagflation risk. So we've got, that's literally stagflation. GDP and growth getting worse, and inflation also getting worse. So we're getting a sort of a stagflation rhetoric by these participants of the FOMC. They also said some participants noted that after several years of above target inflation, longer term expectations could become more sensitive to energy price increases. This is new. Yeah, so this is new. The de-anchoring concern is escalating. So what's changed from the last report? Waller flipped from being cut to holding. Dissent collapsed from 2 for cut to 1 for cut. So no one's really in favor of a cut right now. So Donald Trump, sorry to you, we're not looking like we're getting any cuts, because the members of the FOMC, even if you bring in a new chair, they're not looking to cut. Rate hike language escalated from several, became many, and some pushed for to appear in the statement. So we're looking many people in the FOMC saying we actually need to talk about rate hikes more. Labor market risk assessment reversed. The Iran war entered the statement and was the main point of discussion. So they talked about, so we're going to get those numbers tomorrow. And the staff outlook shifted towards stagflation, essentially. So these minutes confirm what the cheat sheet laid out as the base case. A committee frozen by two-sided risk and unwilling to act in either direction until the fog clears. But the distribution of risks has shifted meaningfully hawkish since January. Rate hike language escalated from several to many. The staff is now projecting a weaker growth and higher inflation combo. Waller rejoined the majority. The only remaining cut vote is Miran, whose seat may not last because he's due to leave, or was supposed to leave a month ago. The ceasefire announced this morning changes the picture going forward, but these minutes reflect the committee's thinking before that development. So if the ceasefire holds and oil stays around $90, the inflation pressure fades and the path to a second half of the year rate cut opens. If it collapses, the stagflation risk the committee is clearly worried about becomes the dominant narrative, and rate discussions get louder. Friday's March CPI and tomorrow's PCE is the next data points that really matter. If headline spikes on energy but core stays contained, the market could look through it. If broadens out above 3%, the repricing towards zero rate cuts or hikes accelerate. Okay. So Final thoughts. Let's show you the charts, and I'll give you my final thoughts, which was essentially what I just said. The war has come to an end. Thank God for that. I mean, well, it's a ceasefire. Let's just hope it continues. Yes, there's been breaches of the ceasefire. Yes, we've seen Israel strike Lebanon and Iran, and probably the other way around as well. I don't know, but it looks like the ceasefire is being breached. But that's normal in times of war. Remember, ceasefire comes out. There's a few breaches. Everyone gets the memo, and then the question is, in the next 3 days, are we going to get any more attacks? Let me just show you, because the markets are heading down on this news. The S&P 500 obviously is up on the day. Let me pin this. Let me close the poll, and then Vaz will be live in the next few minutes. So the war ceasefire, thank God it's effective. Let's hope it holds. And once it is holding and the Strait of Hormuz is opened, then the Fed might look at this, and depending on what parts of inflation, which we'll be covering tomorrow and the day after, are rising or falling, oil we know is going to go up. But if other parts of the inflation data is also going up, then we've got a major issue on our hands. If not, then the Fed can try and look past it once again. Don't expect 4 or 5 rate cuts. The Fed saying maybe 1 rate cut, the market saying no rate cuts, and some banks are saying actually rate hikes. We will see inflation on the next 2 days. I'll be sending out a report of what we've just got in the FOMC minutes, my personal thoughts on this, and I might be doing a stage event later. Final call, anyone that hasn't got the newsletter yet, the ceasefire is already over. What do you mean, songs for space? The ceasefire is already over? I hope not. If the ceasefire was over, the market would be crashing. No ceasefire. Iran wants it to respond if yeah, well, let's see if it holds. It hasn't completely faded yet, but Israel hasn't respected the ceasefire in Lebanon, and Iran might retaliate. Let's see what happens tomorrow. Let's just hope the ceasefire holds and they find a secondary deal. It hasn't completely broken yet. We'll see what happens. We'll be covering the inflation tomorrow and the day after, and of course, if there are developments, we'll come live and tell you all about them as well. So I can see the countdown for Vaz's show. So yeah, last call now, because there is how many's left? Let me refresh and tell you exactly how many's left. Yes, there's, let me just make sure I'm getting this right. Here we go. Let's use this link. Okay, I'm giving you a link in the live chat. Some people said the other one didn't work, so I'll give you this one. This is also a 50% off link. 3 people left. 3 people can get the newsletter for 50% off. That is the link in the live chat. Once you press it, you get access to all the perks, which is the daily premium briefings, the macro cheat sheets for major events, the premium only trading view indicators, the full chart course, which has just been released, plus the private indicators, all based on evidence. £5,000 portfolio challenge. You can see all my trades in that. Portfolio tracker and the financial control sheet, which is basically an app we developed just for premium members, and the priority DMs plus the private Discord access. If you want all of that, there is a link in the live chat. I will have to end the show now because we've got a very important show starting literally right now, which is Vaz with eVTOL Hub. Okay, let's go over to his show. I'm going to give you guys the link in the live chat. Let me just refresh it. Let me see if I can see Vaz live. Yes, his countdown is on. I can see him live. Perfect. So here is, let me end the poll and make sure this is connected. End the poll. Stay where you are because I'm going to tell you about the most important sector. Let me just make sure. Perfect. So the poll has just ended. Let's have a quick look. Will the Fed cut rates in 2026? Yes, said 41% of people. No, said rates stay high, 31%. Too early to tell, 18%. Fed might even cut rates. Guys, the Fed might even hike. 10% of you said that. It should be 100% of you guys. They are, they might. Sorry, I don't know if they are, but there's certainly a real risk that they will. Stay exactly where you are. if you stay where you are or click this link, you'll be going over to VAS. VAS is our eVTOL specialist. The most exciting new sector in the stock market, the most exciting new companies, flying taxis. It's not looked at enough, and VAS will do a great job. So if you can go there, the link is in the live chat, and just say Sensei sent me. Just go into live chat and say Sensei sent me. Stay there. It's a very short show, and he will tell you all about the sector. I'll be live in the morning with the inflation. Thank you everyone for tuning in. Go check out the newsletter, first link in the description, and also go check out VAS, and please just pop in there and say Sensei sent me. Until next time, take care of yourselves and each other. Bye.